Tesla jumped despite missing revenue and profit expectations. The S&P 500 gained on the back of a pullback in US yields following a surprise and an unexpected weakness in the latest US PMI numbers. The euro dollar, on the other hand, jumped yesterday following a surprise strength, this time in April activity in the Eurozone, and the FTSE 100 hit a record high. More earnings are due today from the US and elsewhere. So welcome. This is Swissquote's Daily Market Talk. So, as expected, Tesla's first quarter results didn't look good at all. The revenue dropped 9%, the first revenue drop in 4 years, and net income plunged by 55% compared to the same period last year. And these numbers were not only bad, but they were also worse than the expectations for the third straight quarter. But apparently, the real expectations from the markets were even worse than those that have been penciled in by analysts, because investors could actually look past the ugly quarterly results from Tesla yesterday and send the stock price 13% higher in the after hours trading. Yes, there is no mistake here. Tesla shares jumped 13% after announcing a revenue and an earnings miss in the first quarter, because the company said that they will still focus on accelerating the launch of new models. And the new models include cheaper models that would cost only around $25,000. So that's obviously and clearly in contrast of the latest reports that we saw regarding the company's plans to prioritize robo-taxis over cheap models. So either Elon Musk understood that bad quarterly results and unrealistic dreams of robo-taxis were just too much for investors, or the earlier reports regarding the company's plans to prioritize robo-taxis and scrap cheaper models had no funding. But in all cases, Tesla investors took a sigh of relief after yesterday's report, hoping that losses could slow down following a nearly 50% plunge since last December. But I actually doubt that the post-earnings recovery in Tesla's share price will last long, because there are a few challenges on the way. Elsewhere, Apple eked out a small gain yesterday despite news that iPhone sales in China fell 19% in the first quarter, while Huawei's rose almost 70%. While Texas Instruments rose on good news this time, they gave a bullish revenue forecast for the current quarter, hinting at a slower decline in chip demand from industrials and car industry. I continue with the company news. Spotify rallied 11% yesterday after CFO said that historical price increases have had minimal impacts on growth, a few weeks after news that the company is planning to increase its prices later this year. Then GM raises 2024 profit outlook, and Visa's profits surge amid higher credit card spending. Meta, Ford, and IBM will be reporting their first quarter results later today. So, that's about it. Overall, there was nothing too worrying in company news yesterday, and even the bad news, like the iPhones and Teslas, for example, saw a positive market reaction that was partly due to a decline that we saw in US yields yesterday following a set of lower than expected PMI figures from the US and a strong sale of 2-year Treasury notes that saw the yield settle near the 4.90% level. So according to the S&P survey, the expansion in US services was unexpectedly slower than expected in the month of April, while manufacturing PMI slipped below the 50 level into the contraction zone, whereas analysts were penciling in a faster expansion. So the US dollar fell sharply as a reaction to the latest PMI data, and the greenback's major peers like euro and sterling strengthened. But note that the euro dollar was already up before the release of the US PMI numbers yesterday, as the PMI PMI data from the Eurozone actually revealed a surprise rise in German and French service activity because the German services expanded fast enough to push the composite PMI in Germany into the expansion zone. Now, note that German manufacturing, which is normally the country's main strength, still came in weaker than expected by analysts, yet the better than expected Eurozone PMI overall, combined with the worse than expected US PMI numbers, sent the euro dollar above the 1.07 level at yesterday's trading session. Today, we will be watching the German Sentiment Index, the 10-year Bund auction in Germany, the US durable good orders numbers, and finally the US 5-year note auction. Let's see what these numbers and these auctions tell about the market sentiment. Now, in Japan, the Japanese yen strengthened, but just a little bit at yesterday's trading session, and the gains remain quite limited after news that the Bank of Japan will focus on the falling yen when it meets later this week. A BOJ official said that, well, the BOJ is getting this close to intervene in the FX markets, but the yen shorts have gained enough confidence over the past couple of weeks, especially after the dollar yen passed about the 153 level, as the much expected intervention above this level just never came. And even though we hear that the Japanese will intervene at some point in time, well, the medium term trajectory will be hard to reverse for the Japanese yen unless the Bank of Japan gives hints of further interest rate increases in the foreseeable future. In Australia, while the Aussie dollar extended a rally to the 200-day moving average after a series of inflation data from Australia came in stronger than expected by analysts and fueled the Reserve Bank of Australia hawks. Now, trend and momentum indicators are about to turn positive for the Aussie dollar, but the US dollar weakness is subject to important risks this week as the first quarter GDP update and the core PCE index from the US could easily reverse the recent weakness that we see in the US dollar and will send the dollar soaring again against major peers on melting rate cut bets from the Federal Reserve. In the equity space, well, news of improved activity boosted appetite in the STOXX 600 index ahead of very closely watched bank earnings from the Eurozone in the next few days. Now, note that the European banks have been performing very well in the first quarter as high European Central Bank rates boost earnings and earnings expectations, and high capital returns attract investors. Now, the severe retreat in ECB rate cut bets in the first quarter should also continue back the optimism, but the banks should deliver to keep this optimism and this rally going. In the UK, the British FTSE 100 index advanced to an all-time high level and is expected to further benefit from the developing reflation trade across the globe that should back the mining and energy stocks in the FTSE 100 index. In the US, the lower US yields help the S&P 500 rebound at yesterday's trading session and technology stocks led gains. But there are mixed views on the market regarding the future of the US stock rally, because Citi, for example, says that the current earnings season in the US could refocus investor attention on solid underlying fundamentals and see the price pullbacks in the S&P 500 as a buying opportunity, while Morgan Stanley's Mike Wilson highlights that the bar for the mega technology stocks in the US are just too high and that the stock prices may react in unexpected ways to the earnings reports. And he is not wrong, because not that Netflix fell after reporting blowout subscription growth in the first quarter, while Tesla just jumped yesterday after announcing a revenue miss. JP Morgan's Marco Kolonovich, on the other hand, he thinks that the downside correction in the US stock markets and the US stock indices should continue. But he's an all-time pessimistic, and I'm not really sure that he is a good reference in a market that actually runs from record to record since a while, and despite the rising US yields. Now, in commodities, US crude jumped to $84 per barrel level yesterday as yesterday's API report printed a 3 million barrel decline in weekly inventories in the US, while gold rebounded after tipping a toe below the $2,300 per ounce level, and that was, well, in a mood that's reportedly and mostly caused by margin calls. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.